Please note that the content shared here is for educational purposes only and should not be considered personalized investment advice or a recommendation to buy or sell any specific securities. The analysis and opinions expressed may contain flaws or overlook critical information, so we encourage you to double check the accuracy of our comments. Both my guests and I may own some of the securities we discuss, but these are shared as examples and may not suit your personal circumstances. So it's essential that you perform your own due diligence before making any investment decisions and always consult a qualified financial advisor before taking action with your portfolio. And with that being said, let's get started. Welcome back, everybody. Welcome back to another episode. This time we have two guests on the show. We have our regular co-host, Andrew, and we have Rookie back on the show again, who was a guest on an episode in which we discussed Moncler, his investment in Moncler, which I think you exited by now, right, Rookie? So first of all, hi to both of you.
Hi.
What's going on?
Am I right that you sold it?
Yes, I did sell it.
Okay, let's not get into the details here because otherwise that will take too much time. I have one slide here, start the timer, so I'll do that because our goal is always to keep the show below or at around the 1 hour mark. We rarely get there, but I want to hold myself accountable to sort of arrive at the 1 hour mark. So the first segment will in future episodes always be if there's anything interesting you've been reading, watching, or listening to. And I will just start myself. I shared this, I think, in our WhatsApp community too, so I'm not sure if you saw it. And I can't list the source because for those who see it on YouTube, maybe it's a bar chart and it's annotated and it says like LOL in it, basically painted in paint, I guess. So it's not the original source, and I don't know who actually published it. But what it shows is what factors were basically driving stock performance over the last 9 months, and also relative to the factors contribution over the last 20 years. That's basically the dots that you can see here. And basically the main forces or the factors that were driving stock performance primarily over the last 9 months were high 9-month price momentum, high 12-month price momentum, and high beta stocks. So for fundamental investors, pretty much aspects that you usually don't place a lot of emphasis on. And the factors you would pay more attention to, valuation metrics, which historically have also been like stronger contributors to stock performance, and factors that were contributing more to stock performance were valuation ratios like EV to sales, EV to EBITDA, price to earnings, price to operating cash flow, and high dividend yield stocks. And all those factors were basically major laggards in 2025, which I think tells you quite something about the current state of markets.
Yeah.
Anything you want to add here, comment on? I'm not sure.
Yeah, I mean, it's definitely a growth-driven market right now, but as you kind of alluded to, it's also largely momentum. But is most of it justified? I'm not sure. It's tough to tell. I think the current vote on Wall Street right now, anyway, is that, and amongst retail investors, is that it's a paradigm shift market, meaning, for example, I think everything is getting bucketed together. So companies where revenues are, or revenue growth rates, I should say, are declining, the current consensus is that those are going to continue to decline until they effectively are negative, and that these so-called value stocks are actually value traps, and which of course might be true for many. But there's probably, if you're willing to dive in that area, there's probably some babies getting thrown out with the bathwater. And then likewise on the other side, the strong momentum, the strong growth, much of it could potentially be justified. I mean, we're seeing some businesses triple, quadruple revenue year over year, some very large businesses doing that too. So I mean, it's we definitely are in a paradigm shift, right, with the new technology coming out and new entrants coming into the space. And there will certainly be disruption. And I think it's clear that people want to own the winners, and people are afraid to hold the so-called losers until that dust settles. But yeah, I think that's all that's telling us, and I think part of it's justified and part of it's probably not.
Yeah, yeah. What I
I
would
totally
say,
agree.
yeah, I feel like the last part is important here. I feel like human beings are wired to go with the crowd, and it just is mentally quite hard to buy something that's not popular right now. Take a high dividend yield stock, for instance. However, I think ultimately, and I tweeted about that today, like maybe an hour ago. Ultimately, if you want to be like highly successful in investing, I think you have to be a contrarian at the right times. But it's just fundamentally so hard because say you buy a stock that's trading at, I don't know, 8 times free cash flow right now. Maybe it's not the fastest growing company, but certainly no one's talking about it right now. Maybe it's not having any AI exposure. But being able to buy it at that valuation, thinking about it as a long-term bet, and at some point the sentiment will most likely shift if the company is not a dying business. My point being, this is just so hard to do what no one is doing. Like it's much easier to buy the next AI growth story right here at, I don't know, 50 times sales. Certainly harder than buying something that's super unpopular, maybe boring, maybe in the energy space, for instance, which along with healthcare is like going through a major downturn, or like it's like if you look at fund flows, I think these two sectors have seen the largest outflow, capital outflow almost ever, or at least over the last 10 years or so.
Yeah.
Yeah.
I mean, there's also just limited capital. Well, there's a lot of capital spread amongst limited players. So, I mean, if we think about public companies, let's just take an obvious example, which would be Salesforce versus Palantir. They virtually do the same thing. They
Mm.
are currently, I think, maybe around the same market cap. Palantir maybe even slightly higher. But people are looking at the growth rate, saying it's the new incumbent versus the old player. And Palantir is, I don't know, growing 100% year over year, something like that. And Salesforce is growing, I don't know, 10 or 11%. But on an absolute basis, Palantir is growing their revenue $4 billion a year. Salesforce is growing their revenue $4 billion a year. So, um, I think kind of what we're seeing is just there's kind of the limited players. That might have not been the best example because there are more players in that space with Snowflake and things like that. But especially with these AI players. So for example, Figma versus Adobe, you're just seeing if you're a fund manager right now, you can't be stuck holding Adobe when Figma's the new hot thing, right?
Yeah.
Yes.
So you have to pull capital out of Adobe. You have to put that capital into Figma because there's no other players that are publicly traded in the space right now. Um,
Mm.
with that said, some of these scenarios will end up playing out where, and this is just an example, but where Adobe might be the loser in the long run and Figma might certainly be the winner. Now,
Mm.
however, going back to, Charlie Munger has spoken about this before, where investing is simple, but it's not easy, and it is extremely emotional. But I mean, that's why should it be simple to make a lot of money, right? Like, or why should it be easy to make a lot of money, I should say. So yeah, it is completely a psychological, it's an emotional game. And unfortunately, if you want to make a lot of money, a lot of times you have to say, I'm right and everyone else is wrong. Now, statistically, those odds are against you, which is also why this game, you kind of, I think any person who wants to be an investor and pick individual stocks, you almost have to have a personality of overconfidence and slight ignorance. As crazy as that sounds, of like because every time you pick a stock that's gone down, let's say, you
Mm.
have to have the mindset that you're right and everyone else is wrong, which
Yeah.
is
And I
is a
think on
very
top of
bizarre thing to do.
yeah, I think on top of that, you need to have a pure rational mind. where everything is
Mhm.
just purely rational without emotion involved. Because within these markets, it is emotional driven, like you're saying. There's loads of narratives around them, and so your assessment of whatever you're buying has to be purely rational if you are going to be contrarian yourself.
Yeah, yeah,
Yep.
I agree. I just pulled up one tweet that I also saw like not too long ago, maybe an hour ago too, which sort of illustrates what I was describing and the two of you too. So Pythia Capital tweeted along with the stock chart of ClearPoint Inc. I don't know that company to be honest, but basically the stock chart shows pretty much a drop of, I'm assuming 50% over time. So from January 1st till I'm assuming today, the stock was almost constantly losing value, and then it pretty much doubled. It's more up more than 100% um, during the spike here towards the end. And he tweeted, "What you see is a 50% year-to-date performance, but what you don't see, watching your net worth go down basically every day for 9 months, while the market and everything in AI rips higher." And I feel like that encapsulates quite well what I was trying to describe. But sometimes that, call it, I'm assuming some kind of catalyst was at play here, but sometimes getting to that sentiment shift or that catalyst that unlocks the true value takes even longer than just 9 months. It can take 5 years sometimes, and then the stock triples over I don't know, a 3 month window, and you end up with a great 5 year performance, but for 4.5 years you felt like an idiot. So
Yeah.
that's what makes investing so hard, I think.
Yeah. Multiple re-ratings typically multiple re-ratings, both to the upside and downside, when that's part of the overarching theme, happen extremely quickly because
Yeah.
it's typically followed by a shock of numbers or something went right or wrong that
Mm-hmm.
no one was expecting. So then it becomes a momentum play. Then
Mm.
because it's a momentum play, you have a different set of investors coming in. And then if it was a narrative shift, that becomes a growth stock, which now has a different set of investors coming in. And I mean, these narrative shifts cause extreme multiple re-ratings in stocks extremely quickly. So yeah, the unfortunate part is though, until the story or the narrative changes, you're going to be stuck holding that bag, which is why you really have to, if you're buying a multiple re-rating stock, you kind of have to protect your downside in the sense that, I'll use PayPal as an example. That one hasn't moved in a couple of years, but that company has told very stable business. It's grown virtually every single year at above rate of inflation. And they've essentially told you that they're going to take virtually every dollar they earn and buy back stock, right? What you don't want, if you're waiting for a multiple re-rating, you don't want a management team that you're kind of skeptical about what they're going to be doing with that capital, right? Are they going to be making crazy, speculative investments to try and grow their business, right? So I think there's certain businesses you'd rather own for a multiple re-rating and ones that you probably wouldn't want to take that chance on. That's just my opinion, though.
Yeah,
Yeah.
that's interesting.
Yeah.
The way I look at it is more, I get that point, but essentially, it depends on how you're investing. If you don't care about the re-rating part and you just want to own the business and you just want to be a business owner, then you can wait. Those 5 years don't really matter because you know what you own. As long as, like the fundamentals stay the same, management do what they said they were going to do, then you should be able to, although it's not
Yeah.
easy,
Correct. Yeah.
you're still able to ignore the noise or not look away and not care,
Yeah. The
or
the
even
only
buy,
caveat I would
buy
add to
more.
that. Yeah, well, yeah, definitely. The only caveat I would add to that is if you're not waiting on the multiple rating, it needs to be it needs to be a growth company. And
Yeah, yeah, yeah.
those are even harder to because you need to grow your way out of, the reason I say the multiple
Exactly.
rating that can act as, kind of jet fuel on the way up. If you don't care about a multiple re-rating, then you do need the growth behind the company. And those are
Exactly.
extra hard to find because typically if it has a low multiple on it, the general consensus would be that this thing's not going to grow in the future. Um, But when you
Yeah.
can find those, definitely, it's definitely great just to be a business owner and let them do whatever that they're going to do with the cash. Keep growing, keep buying back stock, whatever it may be.
Yeah, definitely.
Yeah, I agree. So moving on to the next piece I came across and that I found interesting and sort of wanted to discuss with you. It's sort of related to the point you made earlier, Andrew, that AI is just the hot thing and like it's affecting a lot of things and it will be a paradigm shift for many companies and many industries. So this is a chart by Goldman Sachs. And on the x-axis, you see the exposure expressed as percentage to automation by AI, ranging from 24% on the very left to 42% on the very right. And then on the, there's the x-axis, yeah. And then on the y-axis, you have labor costs as a percentage of revenue. And then basically within this graph, you find different industries. I'm sure you might have something interesting to say here. What I will say to kick things off is that I highlighted 4 industries that I thought are interesting and where I personally found it most interesting, where they show up in this graph or in this metrics. So first of all, software stood out because the point here is basically on the very right, so high exposure to automation by AI and labor representing a material cost of their overall revenue. And I think we might have discussed that before, Andrew. I think buying software companies will require a lot of nuance and critical thinking because I think software is the industry where I believe you will have major winners and losers. So I think you made the point that proprietary data will be incredibly valuable in the age of AI. And if you're just a consumer-facing app that's just looking good, chances are you will be cooked in an AI-driven world. So software stood out to me. Not sure how you feel about software names. Software as a category, I feel like it's as unpopular as it hasn't been in the last 10 years. So a lot of skepticism towards quote unquote software names, which I think is just too generalized of a category. I think there's so much nuance within that space. Yeah, I'll leave some room for comments here.
Yeah. I've
Would you
kind of
feel
mentioned this.
comfortable owning a software stock here in
Well,
today's day and
yeah,
age?
yeah. Of course, I would. Um, I, I I do think that the moats, quote unquote, these moats surrounding these businesses have by and large fallen by the wayside. I do think that's correct. I mean, I've used the example in the last episode I think we did, which is that you and I, without any outside funding, could go and, without any coding experience or really anything like that, we can watch a couple YouTube videos and get started creating a software company. You didn't have that before. I mean, bare minimum, you needed a salary for software and engineer slash developer. Um, like to create these things, you needed some outside funding. Um, so I do think the barriers to entry have just gotten a lot lower. Um, but once again, talking about, the baby getting thrown out with the bath water is just I I think going back to that proprietary data and kind of how I stumbled onto that was by talking to the sales rep from Samsara, and I was probing him, kind of wondering why can no one else replicate what they're doing, and they've been training on dashboard videos and everything like that for years before they're even a public company, and just their user base is so large that they have all of this data to train on, where they're I think an order of magnitude larger than their closer competitor. Um, and that plus install base, I realized is a really, really tough competitive advantage, regardless of the narrative that all of these companies are going to fall by the wayside. Internal data, right? Proprietary data and install bases are two massive moats that are really, really tough to take down. Now, will there be losers? Of course, there will be. But I just think right now, unless you're the new player in the space or you're cutting headcount and increasing margins, no one really wants to own you, right? If your revenue fell from 15% growth to 11% growth, no one wants to own you right now. That to me, that's not a bad business. I mean, I'd take a business with 80% gross margins and 11% growth at a 14% multiple any day of the week, as long as I think those cash flows are durable. And that's kind of where the market is disagreeing right now. Everyone thinks those cash flows are going to zero pretty much.
So that's regarding Salesforce, right?
Oh well, that specific example was Adobe, but
Okay.
yeah, I mean that goes to Salesforce, Adobe, which I've changed my opinion on Adobe, which we can get into. I don't know if you want to get into that now, or I'll let before we get into that, Rookie, you wanna comment on this at all?
I was just going to say, when it comes to the software piece, there has been, I don't know if you've read articles or reports on that. The problem they're having now is a lot of the headcount that they've cut because of this panacea, which they're saying AI can cover all the solutions they need. They've had to start working through what they call slop or AI slop. And so they've had to rehire people now because you need to check what AI is doing. And some of it has not been as good as what has been promised. So I'm not sure when it comes to some of these software companies where they're being sold because people think they will be go out of business or their moats are shrinking. I'm not sure whether that's the true case. We will see in the future.
Yeah.
I think there's a lot of euphoria around this the new technology around it, and they think that it can do everything when it might not be able to do what is being promised.
Yeah, yeah. I would say, Andrew, I would say it's a good time to discuss your sort of basket bet that you shared with me via WhatsApp, and I suggested we could just discuss it on the podcast. I feel like it's very fitting right now. Before we do that, though, I just want to share like two mental models that I think are critical when it comes to assessing software going forward, and it's sort of tied to what you just described, talking about install base and proprietary data, which is the distinction between barriers to entry, which I think AI definitely lowered, and barriers to scale. So even before AI, it wasn't all too hard to code a social media app. Sure, you probably require a few million dollars of funding, but you wouldn't require like millions and millions to set up that app. But getting this app to scale, pretty much impossible. So I feel like the moats of some of Meta's assets have proven to be way more defensible than many people believed a couple of years ago. And I think the same is true for AI going forward too. And now we may be able to tie that to some of the quote unquote software bets that you made more recently.
Yeah, so I made well, two, I guess you could say software bets, kind of cloud-based nowadays, but and then one has been PayPal, but that's been for a while. That's not really software.
Mm.
That's kind of the both of these are just let me reframe this. So the two kind of newcomers in the space that everyone wants a piece of is AI and then kind of cryptocurrency slash stable
Mm.
coins. And both PayPal, Adobe, Salesforce are all being viewed as the old technology. Now, it's true. Their growth rates have come down. There's a lot more competition in the space. I am not denying that whatsoever. But PayPal, for example, and this goes back to my original thesis. Now the funny thing is PayPal hasn't gotten that multiple re-rating that I expect that I thought it would by now. But even as poorly as PayPal has performed over the past year and a half or whatever since I've owned it, I think on an annualized basis I'm somewhere around 7 to 8% annualized. That is really good for being about as bad as you could possibly expect, right? Heels, heads I
Yeah.
win, tails I don't lose much. So
Exactly.
like that's what I mean. If you can just buy very stable businesses extremely cheaply to protect your downside, the upside eventually, if you're right, will end up kind of taking care of itself. So that's kind of where I am with PayPal. But
And
my
sometimes
original
I'll
thesis,
just add, Andrew, that sometimes a stock may also just go up tremendously for no particular reason, and then you may just use that as an exit point, and you were just lucky. It doesn't necessarily
oh
have to
yeah,
be based on fundamental
yeah.
change.
Yeah,
A lot of this game requires some kind of luck.
Yeah.
Um, but what was I going to say? Oh, so the user base, which I think was, and this is why it was my original thesis, like I said, a year or two maybe at the most, with PayPal, was just the vast user base and the data that they have on all of their users. Now, yes, they were going through a transition phase. Um, but I thought that was just an asset, right? For the past 20 years that they've been collecting user data, transaction data, all of these different things. I just thought that was, I mean, their install base is far larger than anyone thinks. I think it's 2 of every 3 adults in America you have some form of PayPal account. And so I mean, like it's they have it is a very, very large user base, a lot of data. And that was proven out to be true when JP Morgan said that was going to start charging data for their services.
hmm
A lot of, payment companies dropped, and PayPal came out and said this virtually affects us about as close to 0% as you could imagine, right? So the proof, yes, they have all this data. I think now when we see these new AI integrations and stuff, right? Everyone's talking about agentics and different things like that. We're already seeing, I believe, ChatGPT just came out with news saying that they're going to be integrating parts of PayPal's payment system and stuff into their AI responses. I would be shocked if you don't see Google kind of do the same thing and stuff. I just think the data that they hold is an extremely strong asset that's very tough to compete with. And people have been saying the same narrative that, it's a dying business. It's one of the few dying businesses I know that keep growing 5 to 10% a year. Um, like
Exactly.
clockwork. So I don't know. So that's a tough argument to be made. And then I did think, now going back to PayPal and Adobe and Salesforce. Salesforce, it
May I
was
just jump in real quick, Andrew, and
yeah,
comment
yeah, go
on
for it.
PayPal? I'm just going
Yep.
to throw in sort of a provocative take here. So I tweeted this. You can see it on screen right now. I'm just going to read out in a moment. And what I will say, okay, let me read out first. So
I
I wrote,
responded to you on Threads
oh, I didn't see it.
on this
I'm
one.
sorry. I didn't, but then you're well prepared. So I wrote, is PayPal the ultimate value trap? Question mark. On the surface, the numbers are enticing, trading at around 12 times free cash flow and 11 times operating income. It screens as too cheap to ignore. But payments is one of the most brutally competitive industries where being the lowest cost provider often determines who wins in the long run. And PayPal clearly isn't that. It's not the company's DNA. And then in a second part of that tweet, I highlighted that stablecoins may represent like a potential disruptor in that space too. But I also highlighted the data advantage that PayPal possesses. So I'm very well aware of it. And I also retweeted my own post a few minutes later and said, nonetheless, I will probably be a buyer again, sub $60 a share. I used to own PayPal for a brief period in time for the
Mm,
reasons you mentioned. But Rookie, I want to bring you in here real quick because um, like honestly, payments is super complex, and I used
it
to
is.
ignore that space for a very long time because I acknowledged that I might not fully comprehend it. But as you own Wise, just like I do,
Yeah.
like one mental model that I find incredibly helpful here is to just go for a scale economy shared player, which Wise is and PayPal isn't. So that is holding me back. I'm not sure if you have a view on PayPal.
Um, I agree with what Andrew's saying in terms of the proprietary data. I think PayPal is a behemoth in that regard. I even have a PayPal account, and I sometimes when you're paying for something, it just makes sense to use PayPal. You might not think about it, but you're given
Yeah,
the option and you just use it. So it's kind of
yeah.
like a background. It's kind of like, how would I say? I would say that's kind of like a moat because it's in the background, but people use it without, really realizing.
And
that they have.
maybe you can enlighten me here. I think when you use PayPal as a checkout option, the take
Mhm.
rate is paid by the e-commerce provider or like the shop anyway, right? It's not paid by the
Yes.
consumer.
Yeah. So, and like it does have mind share. Everyone knows what PayPal is, right? So that just adds to the size of the company itself. Whether stable coins or something like that would disrupt PayPal, I do not know, because I don't see that. I could see PayPal also being able to play in that space anyway.
Yeah.
Um, on the other side, I own Wise, just like you, and my attraction to Wise is the fact that it's a scale economy shared uh, business and is also in the same space. And as a cheap option or a cheaper option, that's part of its appeal. But we, as a whole in the payment space, we do not know what happens if there is some kind of stable coin option that comes to the fore that costs less. You know, if the cost and friction gets
Yeah.
taken out because of stable coins, then that's good night for some of these businesses. And that's where or if, God forbid, but if someone like Meta came up with a payment system, I do not know what would happen in that scenario, whether they would take other people's lunches. But yeah, I think both PayPal, I think, has been overly sold. And then Wise, because I'm invested in and maybe I'm biased, I just think the way they're operating, the way they're doing things is particularly strong. But they don't play in the same space, so to speak, as well. So
Yeah.
it's
What
not exactly apples and oranges. Go on.
I just want to cut in about, and I hear this argument a lot, and you just reminded me to comment on it.
Mhm.
So about the take rate, and there's lower cost providers. That is in my opinion, one of the largest misconceptions out there is that a lower
Okay.
cost provider will take the market share. Now, sure, merchants obviously want to go with the lowest cost provider, but let's be realistic. What merchant accepts nowadays, with the exception of maybe, 5 or 10% of small businesses out there? What merchant, okay, let me just ask you this. What merchant only accepts cash nowadays because they don't want to pay a processing fee? Virtually no one. Everyone pays the credit cards that 3% fee or whatever it's going to be, and that's only for merchants because that's what the customers want, right? It doesn't matter if I'm a merchant and let's say Joe Schmo wants to use his PayPal because he gets 5% cash back on a category, and that's what he's going to pay with. I have to pay a 5% fee. I'm going to tell him, no, you can't use PayPal when that might be a loss of a sale. I'm not going to not accept PayPal because the fee is larger than cash or because the fee is larger than another competitor that this individual doesn't use, right? The merchants don't get to decide the customer base based on what they're going to accept. That's the whole reason everyone accepts Discover nowadays. For the longest time, MasterCard and Visa were always a cheaper option than Discover and Amex. So, and I'm talking in America now. I can't really speak for kind of where you guys are, but
Uh-huh.
for the longest time, people would say we do not accept AMX or Discover until they realized the loss of sales because people would say you don't accept AMX or Discover. Okay, I'm going to go to the bodega down the street or whatever it may be.
Yes.
The fact of the matter is, it's the consumer decides where they want to put their money, and unfortunately, whether it's a low cost provider or not, the merchant has to accept it. So that's also kind of my issue with like stable coins. The whole stablecoin things, yeah, would it be better for merchants? I'm sure it would be. But at the end of the day, what's going to incentivize me when I get 3% cash back on everything and then an extra 5% cash back on a category for that month? I'm going to be paying with my PayPal everywhere I go, right? I don't care about the merchant. I want to do what's going to be best for my pocket. And unfortunately, because you're a merchant, you just either have to accept my business or, you know, not accept my business. So I
Mm.
think that's a tough argument to be made. I think people keep trying to make that argument. And that's just kind of not the case. The merchant doesn't get to choose what the customer is going to be paying with. Unfortunately, that's just the reality of the world.
Yeah.
Does that
Rookie,
make
if you,
sense?
you have nothing to comment here, I have something to throw in.
The only comment I'll make is when I was describing why is it a low cost provider, it's not playing in the same space as PayPal, is it?
Yeah.
Correct.
It's providing
Correct. Yeah.
it's providing a service between a client, like a customer sending money to themselves or to someone else, and that low
Correct.
cost, that providing the low cost is the advantage there. Whereas in your scenario, of course, PayPal, that does not affect PayPal.
Correct.
Yes.
And also I'd like to add on that PayPal, even though it has an offering for remittances, it is an awful offering. I don't think PayPal would ever compete with Wise on that, and vice versa. So yes, that is a good clarification that you made, and I'm glad you brought that up.
Yeah. Two things here. I feel like in terms of being the lowest cost provider, and I should say that I don't know the payment processing space all too well, but I feel like a good comparison to Wise would be Adyen, which in my understanding is a company that is also very focused on driving take rates down, and they have certainly seen like tremendous growth over recent years. But I wanted
Yeah.
to like, first of all, I find your point very convincing, Andrew. But I want to throw in a potential counter argument. So what I was thinking is, I feel like the payment processing space reached its peak sometime during the COVID era, and you might have seen screenshots of it where people showed how many payment checkout options you had. Like you have all the ones everyone knows, like Visa, Mastercard, PayPal, Klarna, Amazon Pay. What am I missing? There's more. Some smaller competitors,
Mm.
and you could argue that once you have too many options, that will actually harm conversion too, because well, you have a consumer who's confronted with 10 options, and that's just another burden or obstacle between well the actual purchase and the consumer maybe leaving the website. So if there are already some other trusted options except PayPal, I feel like you're spot
Mhm.
on. PayPal has great consumer mindshare and trust, which I think plays a critical role here. But if there are other options consumers trust, merchants may actually reject the option that is just more expensive than the other options. Does that make sense? I was just trying to
Yeah, it
throw in
makes sense.
a counter argument here.
Well, that would be part of the bear case, right? I mean, there is a reason why PayPal's trading at like an 11 time forward earnings, right? So there's plenty of bear cases that could be made. Like I'm not ignorant to that fact. I just personally, and that's obviously why I own it, is I think there's a large disconnect between current valuation, current kind of thesis behind the company, and probably the true economics. By the way, a little sidebar comment: if you do want to learn a lot more about the payment space, I would deeply recommend the Acquired podcast episode on Visa. I believe it
Yeah,
was Visa.
yeah.
Definitely listen to that. I think it's like 4 or 5 hours long, but that was a
Hmm.
massive stepping stone for my own research a couple of years ago.
I haven't listened to that one. Sounds great.
Yeah.
All right, you were about to transition to Adobe and Salesforce.
Yeah, so Salesforce, the biggest issue for me has two things actually. So Salesforce was always kind of valuation, was kind of tough even after the company, the stock came down. I don't know, whatever it is, 50% or something, 30% maybe. The valuation always kind of seemed a bit too expensive for me, until you kind of dig deeper and realize it's probably more of a margin expansion story nowadays. Putting that forward multiple probably cheaper than I think most people think, and then especially like a 2 year forward multiple. Like I think this year alone they're growing earnings like 80% or something like that, and that's just by and large margin expansion. And then so that was kind of always my issue with Salesforce. The second issue I had with Salesforce, which I still kind of struggle with is his argue, which is funny because I'm a big founder guy. Like I love founder-led companies. Mark Benioff, and I get it. He's a salesperson. I mean, that's why his company became so great is because he was like the OG sales guy for a SaaS company. Um, but yeah, I just sometimes he seems a little douchey to me. But so
Yeah,
a bit
I
of a
get
turn off.
what do you mean?
Yeah, and then Adobe, I actually just recently came around to being not necessarily bullish on Adobe. Just once again, I think everyone else's viewpoint on how doom and gloom their future is probably just a bit misplaced. To be fair, I've been in that camp for a while, thinking I think Adobe is going to, you know, 0 10 years from now type of thing, right? Not really zero, but I did not think it was going to be, you know, I did not think it was going to win through this kind of AI revolution. I definitely thought that
Right.
was going to be a loser. Until recently, there were two key things I learned about. And this was talking to someone, so my best friend's wife, she actually does design full time. That is her job. And she uses Adobe. She's deeply integrated with it. And there's a couple things about Adobe which I learned, which I hadn't really considered. Number one is the install base. Of course, it's the leader for anything like this. It has a full suite of products. That is very difficult to take down. And actually, the Steve Eisman podcast, they just recently discussed about that as well, with Dan Ives. So
How large
that
is
kind
it?
of
Do you know the figure?
they don't publicly disclose it, but I think 34 million paying subscribers or something like that. And that, I mean, that also includes like massive enterprises and stuff too. That's government agencies, you know, schools such as Harvard or something, right? So a lot of those are massive clients. But I think the confirmed number is over 30 million, probably closer to 40 million. Um, and the second competitor is not even close to that. Uh, with that said, so I was like, you know, things like Canva and generative AI, I was like, that is going to really destroy Adobe's business model. I understand why the valuation is as low as it is, right? Like that one I did consider to be a value trap. Where my kind of opinion changed on that was number one, the install base. Number two was the data. I didn't know that in their user agreement, they actually collect virtually all of your data that you use when using Adobe products. So as long as Adobe's been around, they've been collecting every edit, every photo that you create, every workflow that you do. They have data on all of that stuff. That is purely, you know, IP to Adobe now. So when a competitor oh, and before I get too off topic there, and then the third thing is one thing I didn't even consider, which is why my friend's wife says is actually a big reason they have to keep using Adobe is I forget what it's called, like Safe AI or something. If you look into it, pretty much it has to do with intellectual property and infringements and stuff. So a lot of this generative AI right now, you can't really use that on a professional level because you don't know if there's going to be copyright infringement. Adobe,
Exactly.
because everything is internal data with Adobe, they've been training on their internal data for years. They have such a vast array and variety. Anything generated by AI, not only do you know that it is copyright free, you also know Adobe has a clause where they will back you with any kind of lawsuit either. So that's why like a lot of these large enterprises, it's not worth them switching over to something like Canva. Yeah, it might save them, I don't know, an annual subscription. Let's pull a number out of my butt here. Let's call it $1,000, right? They're not going to not pay $1,000 a year because they might end up with $1 million lawsuit on their hands, right? It's just it's not worth it to them for that.
No, it's not.
So once I realized that, and then also how deeply embedded they are in like government agencies and in the college and education system, we all know how slow that changes anyway. Like even if Adobe was like the worst product in the world tomorrow, it would probably take them 10 years before they changed over. So, but yeah, so I after considering kind of all of those
Can I just
things,
ask a rookie here real quick if by any chance you have had any interactions on that particular topic, so IP infringements in terms of AI? Because I'm not sure
Not
in your day job, because
in
for
my
those
in my
listening, you're basically practicing law. Is that a fair way to describe it?
more or less, yeah, yeah. I would say there's things that have come up, not particularly with Adobe. Some of our contracts have come up in terms of copyright infringement and stuff we've had to renew. Where I'm at, we do use Adobe as well. So, and they won't switch anytime soon. So
Yeah,
this is why I was saying to Andrew, yeah, I kind of agree with him in that in that sense that because because it's almost like an expertise by Adobe, right? That you know whatever you're doing is safe for the moment until someone like Canva also attain that kind of same position. Why would you risk it? Especially if you've been using the same thing for a decade. Why change?
yeah,
yeah.
Definitely.
yeah. To me,
Yeah.
that was the strongest of the three arguments presented so far. I feel like that's a very convincing point.
Yeah, and it's honestly it's just one I didn't even consider when I was so bearish on Adobe. It literally did not consider. I was like, I was just messing around on Google AI yesterday on Gemini, and
Mm,
I created these phenomenal photos. I could tell it what to edit, change words, this and that. And I was like, oh
yeah,
my God, this is great. And even so, it's all being trained off of things on the web, right? Like
exactly.
there's no way I could use it if I was Pepsi. There's no way I could use any of that, right?
No, no,
I'd
no.
have to. I could use it as inspiration, but then I'd have to go out
Mm.
and create my own thing. What product would I do to create my own thing? I'd end up going off of Google Gemini and then hopping on to Adobe Photoshop or something, right? Like so. No, I could be wrong. I'm not really an expert in this space. Just kind of the information I got from someone in this space was very compelling. Also, these large enterprises too, don't forget, they have, you know, oh, the workflow thing was something I was going to say too. I know I'm kind of flipping back and forth here, but the all the data they have on workflows too, it's going to be tough for someone to come in and create like an automated workflow for certain things when for example picture this workflow what I'm talking about to be an autocomplete, and this is what my friend's wife was explaining to me as well too, because she might have to do the same process over and over and over again, and Adobe kind of has years of data on that. It is very easy for them to come out with a tool to help almost auto-complete that for you, right? But instead of autocomplete, it just knows that, hey, when they import, this image, I already know that they're going to want to make this adjustment, do this, do this, do that, right? So, I think there's just a lot of compelling features that Adobe can probably do, once again, based because of their data set, that probably a lot of competitors can't do. And of course I could be wrong on that, but that's kind of where that basket bet came from, was that I think these are perceived to be, you know, new AI slash crypto losers, where I just think the data that they have is really probably untapped gold or undervalued gold that I think people are probably overlooking.
Yeah.
Yeah, I don't have all too much yet. I was about to ask you in what way that data is valuable, but you explained it very well. And maybe just to wrap up that segment, more of a general comment here. I feel like there are, at the extremes, obviously two ways to play this. I feel like you can lean into this and actively look for what what might be considered, you refer to it as AI losers, and have a contrarian view on that. Or the other option, the other extreme, I guess, is to just avoid that space entirely. I think that's probably what Buffett would do, because he has always been quite vocal about betting on businesses or maybe industries more specifically, where the rate of change is very slow, and AI is quite the opposite of that. But then again, like personally, I also like just really enjoy the intellectual challenge of thinking these things through, and potentially, we talked about it earlier, having the confidence to step in the ring and say, I think the market is wrong here, and Adobe, for instance, may actually end up being an AI beneficiary.
Yeah. Well, and also, like, full disclosure to your point, yeah, this basket bet alone is 15% of my portfolio. My largest position is 35%, followed by 30%, followed by I think 25. Like
Yeah.
this basket bet together, I count as one position, and it's the smallest position in my portfolio too. So I feel like a full disclosure is required
Yeah,
in that
and
And
that's
sense.
perfect. And it's
and I
no
was
investment advice anyway on this show. So we're just
No,
discussing
no.
everything for the sake of entertainment and our personal enjoyment. Rookie.
and I was just going to add that in the case of something like Adobe, there is I don't know why people pretend like there is no chance that they will adopt AI themselves to enhance themselves. That can happen,
Yeah,
and they will.
well, they already have. The argument
Yeah.
against it is that, going back to the low cost provider, the argument against it is no one's going to want to pay for Adobe when something else I can do just as good for free. But,
Hmm,
for the reasons I had just mentioned, I was
exactly.
also in that boat, and I kind of transferred over. But like they've already adopted AI like
Hmm.
really, really well.
That's good.
And
So I was just speaking
I
in general, like some businesses are being thrown out as if they will never be able to adopt it themselves just because they don't speak about it, or they're not perceived as
Hmm.
being able to adopt AI when they already use it, like you're saying.
Yeah.
I
Yep.
was just about to say that but I think I read that online, but I'm not an Adobe Creative Cloud user myself. But I think I read that within Adobe, let's say you want to create an AI image, you can actually choose between the different image creation models. So in a way, Adobe is leveraging the work of the quote unquote AI companies who are coming up with these fantastic, as you described them, image generation models, for instance, and they can
Mhm.
leverage them. I'm sure there's some licensing fees, so no idea what the margin impact of that would be, but they are most certainly not directly competing with OpenAI or Google or Meta here. They are not going to
Yeah.
become creative software companies. It's too small for them anyhow. So that's
Yeah.
not really a threat. I guess the bigger threat, and we shouldn't get into that now. And I think you very well covered it. Would be an emerging competitor who leverages AI better
Yeah.
for the consumer. Yeah.
Yeah, the big fear for them is Figma right now, which is, I mean, by rights, which is why Adobe
And
tried
Canva,
acquiring
right?
Figma. And Canva, yeah, I think the big one is Figma because it's publicly traded, and I think Figma's in everyone's sights because Adobe tried to acquire them, which obviously implies that, you know, Adobe probably viewed them somewhat as a threat, but that was broken up by the FTC anyway. So
Yeah.
Oh.
I just Googled what the current market cap of Figma is because I think it's down quite big since the peak. Let's just see. Down 61%. So the current market cap
really,
is 25 billion. So sort of a thought experiment here would be if Figma declines another 20%, Adobe could start accumulating shares at the price they were willing to pay. When was that? 2 years ago or so. And Figma is likely more valuable today. So I
yeah,
don't know, just a thought that crossed my mind. Okay, looking at the time, we're at the 52-minute mark. So I'm just going
Oh.
to give the listener an overview of ideas I had for the show, and those will not be ideas we will dig into right now. So I would suggest you head to Tobias Carlyle's Twitter profile because on it he shared an interesting chart that showed the development of the profit margins of the S&P 500, the S&P 400, and the S&P 600. And what you see here is sort of a long-term trend of rising margins. And he shared a great tweet on it with some key observations, things like risk that comes with it, mean reversion risk. And also what also stood out is that the gap between the largest companies, being the S&P 500, and the smaller companies, represented by the two other indices, in terms of profitability is widening. So I thought that was quite an interesting observation. Then another, I think, was an interview, made a lot of headlines in the AI world. It was, I think there's a podcast with Rich Sutton, who seems to be a very popular figure in the AI space. And he made the point that he believes large language models are not going to be what gets us to AGI. Because just to wrap up the point, I thought this was super interesting and I found it quite compelling. But as I said before hitting the record button, this is way outside all of our circle of competence anyhow. But the point was that ultimately LLMs are trained on data that was created by humans, and the data at some point will be limited. So there will be no more data to train it with. And the point he made was that to get to general artificial, what is it? AGI, artificial general intelligence, is to create models that are learning themselves more, which LLMs, according to him, don't really do. But we're going to skip that.
Yeah.
In the news segment, if you want to chime in, and we go for it.
Oh, I was just gonna say that's too far out of my circle of kind of competence.
Yeah.
I think yeah, I think there's a lot smarter people on that topic than myself.
Maybe we could cover two more pieces from the news segment. Rookie, we discussed earlier that we both own Wise, and I'm not sure if you saw it in the community, but we discussed for a moment the developments at Stripe. So the founder of Stripe, Patrick Collison, he came out with a tweet and shared it along with the presentation style video of the new developments happening at Stripe. They're sort of also entering the currency conversion space. They are now also offering multi-currency accounts, which means within one account you can hold multiple currencies, basically in sub-accounts. They also launched digital cards that you can create for, I don't know how many regions, but you can basically set up a bank account virtually that acts as a local bank account in France, for instance. I don't think, I'm not sure which countries are covered by Stripe specifically, but that's what you can do with Wise, for instance. And some people have perceived this as very bad news for Wise. And my point was that if these developments worry you as a Wise shareholder, you have to do more work. I'm not sure. I would assume, Rookie, that you share my sentiment here.
I do share. Yeah.
Can you explain why?
I think just the fact that someone comes in and can offer this a thing that looks similar to something else doesn't mean that they're just as efficient or as just as efficient or as attractive as the one who's already doing it themselves. Wise also have, although I don't know Stripe's reach, but Wise has expertise of being entrenched in a lot of payment systems within the countries that it operates in. That is a competitive advantage that it has. And the fact that it, like we've said before, that it's the low-cost provider and is providing value for its customers, that is being rewarded by customers using it more. I don't know Stripe's business model, but I assume it's not the same, and I assume that there is a cost to being able to do what you can do on Stripe.
Yeah. And my perception would just be, and that is what my conviction and the Wise thesis is based on. Building that infrastructure and the speed, transparency, and cost that comes with it is just so hard, and it really takes years and years of networking, working with local regulators. It just takes a lot of time. And if you look under the hood of what Stripe has to offer there, I'm sure they have an inferior value proposition in terms of some of the attributes I just mentioned.
Yeah.
I don't know too much about the competitiveness between the two of them. Just to clarify, so Stripe essentially, if you want to, they're kind of the OG technology behind and once again, actually, the founder slash CEO was interviewed on Acquired 2, their second podcast there.
Yeah.
But they were the ones where essentially when it says if you go to link a bank account, you used to have to do, the routing number and account number and all of that. And instead,
Yeah.
with Plaid, they connect to virtually every single bank in America now. It was very limited in the early days. Now it's virtually every bank in America. And I think they're trying to do this globally as well. But now, essentially, as the customer, you just allow Stripe access into essentially your bank account, which sounds kind of crazy, but we don't even bat an eye over it nowadays. And they just
Mhm.
connect everything for you, like within seconds. So you just say, yeah, link my bank account for me. And instead of having to wait 2 to 3 business days and the micro deposits and all of that, now Stripe just goes and connects everything for you. Bada bing, bada boom. Now I'm connected to SoFi app, or now I'm connected to PayPal, right? And
Yeah.
it takes literally 2 seconds. Now, how they can do that on a global scale, let's say between America to Germany, and make those kind of remittances and transactions cross border there, I'm out of my circle of competence at this point now. But I just want to kind of clarify for the both of you
Yeah.
what they do and where their technology came from. And they are a Goliath, and they are I once again, I don't know the competitiveness between the two, but
Mm.
Stripe is not a force to be taken lightly. So
Yeah. I would also
Yeah.
say, like, overall, the news is a net negative because there's more overlap between the two companies now, and more competition is generally like not good. But I don't think it's something to truly worry about because just regarding the last point you made, like, let's say you want to transfer money from the US to Germany specifically, what's incredibly important is to have connections to the domestic payment systems. And for Germany, that would be the EU domestic payment system. And if I'm not mistaken, Wise is connected to the domestic rails, like quote unquote domestic rails of the EU. Like the EU is not a country, but let's just treat it as one.
Yeah.
Because being connected to these knots, so to speak, that is what enables you to really offer instant transfers and low cost transfers. And on the same day that the Stripe news broke out, for instance, Andrew, it might have been a day prior, but Wise actually announced that the integration into the Brazilian domestic payment system, Wix, was completed, which I think is
no,
the seventh access to domestic payment
Yeah.
rail for Wise.
Right.
And from expert interviews that I've read, I know that the process of becoming part of that or gaining access to these domestic payment systems takes years. So it's not something you
yeah,
can just do like by snapping your fingers. It just takes a lot of time because I can only imagine how much regulatory work is required to
Yeah.
get that done.
yeah, yeah.
Okay, moving on to the next news piece, if you don't mind.
Yep.
This one is for you again, Andrew. So, Jeru Capital shared on X a screenshot. I'm not sure. It's from some kind of article that highlights that Apple apparently is shifting its focus away from, to some extent at least, away from its virtual reality glasses. What were they called again? Vision Pro, to some kind of lighter form factor, which resembles more the AR glasses that Meta is focused on right now. So I'm not sure. What's your takeaway from the Meta Connect 2025 presentation, for instance, in this regard specifically? So AR classes, were there any major breakthroughs that got you excited, or yeah?
Huge, huge breakthroughs. First off, I'd like to comment on that post. This is changed their focus. I didn't know that Apple was focused on any innovation nowadays other than creating a slightly newer UI and adding a fourth and fifth camera to their phone. No, um, the fact of the matter is Apple, and I mean you're seeing it with AI. Apple run by Tim Cook is just a completely different company than the old Apple. He's done a phenomenal job, but it's through financial engineering, and it's just through milking out profits as much as possible. They've tipped their toes into new technology, right? You heard about, when Tesla was the next big thing, they said, oh, we're going to come out with an electric vehicle car. Obviously,
Mm.
that was squashed. They never ended up doing that. Now with like the Vision Pro, it was priced egregiously. It had to be plugged in. Like it was just, I, I I think the management with especially with Tim Cook at the helm is very afraid to go all in on anything, and which, someone like Buffett or whatever would obviously appreciate. I just think it's going to be really, really tough for Apple to compete with someone like a Mark Zuckerberg who's kind of like naturally insane, that he's going to just be taking 4, 5, 600 billion dollars and dumping it into like these new technologies. And they've
Yeah.
also been working on these smart glasses for over 10 years, right? People think it's, over the last 2 or 3 years, something like that. It's 10 years worth of technology.
Yeah, because they
Like,
started during Google Glass when Google Glass were doing their thing.
yeah,
Yeah.
and it's been an incubation in the background of when after they purchased Oculus and everything like that. So I mean, all of this stuff has been in the works for years. There's been plenty of R&D on it, and I'm just not too convinced that Apple, yes, will they come out with a product? Certainly. I don't doubt that. Will people buy it because it's an Apple product? Certainly. I don't doubt that. I'm just not too convinced it's going to have the AI integration that's going to be needed, right? I mean, Siri is laughable at this point. Um, and the issue with Apple is they're going to have to start partnering with third-party sources. Whether it's AI, whatever it may be, just all of these new products they're coming out with now, especially AI, they're going to have to integrate the AI, and they're going to have to partner with third parties now, which historically Apple has never liked to do, right? They've always liked to keep everything a closed source. They don't like to open source anything, and they like to keep everything internal on a vertical stack. I just think they're behind the eight ball. I think they'll come out with products. It's tough for me to imagine that they won't eventually be disrupted. Now, I don't think the transition away from the iPhone is going to be nearly as fast as probably, a lot of people think. So I think they'll be fine for a very long time, but I kind of, I'm not too worried of Apple coming in and disrupting, all of these advances that Meta's making. If so, I feel like it would be some like random startup in a garage that would end up coming in and winning. I just feel like that's kind of the nature of the beast. With that said, going back to your original question of the Meta Connect, yeah, the technology with the
I will
new
just say, Andrew, if you don't mind,
what's up?
I'll
Yeah,
just
yeah.
say one point that I think is worth bringing up. Potentially, Zuck himself would actually welcome it that Apple enters that space. I think he said that before regarding virtual reality classes. That
Yeah,
competition
because
is
it's a
actually a
nod
good
of
thing because
approval.
it helps progress things faster.
It helps progress things faster, and also it's a nod of approval.
Yeah,
And
yeah,
it's in the consumer psyche when Apple, and that is the reality, when Apple does something, the reality is it's their approval saying, yeah, this has the potential to be something big. Um, so yeah, there is an interesting point to be made on that front. Um, but yeah, also you get way more developers working on things as well and stuff too. So I mean, it is a whole ecosystem and kind of a virtuous cycle. With getting more competitors into the space. By rights,
yeah.
I don't actually think Meta cares all that much if they win the hardware side of the game. I think they just really want to be the software, which they missed out with before. Um, but right, I think they want to be the Android of the next generation platform. Is essentially what I think that their mind is kind of at. With that said, what came out of the Meta Connect? They did some live demos. They kind of flopped, ironically.
That was funny. Yeah,
But yeah, but the actual technology themselves that came out. Sure, the Gen 2 for the Meta AI, the Meta Ray-Bans, the second gen. Sure, better battery life, better camera. We knew that was going to come, so nothing too spectacular. The Oakleys, pretty neat, but I think we were all kind of expecting those anyway. What's really, really cool though is the Meta Ray-Ban displays. And I don't want to kind of over exaggerate this, but the fact of the matter is they had to build all of these apps in-house because there's no, third-party developers yet. I
Makes sense.
think when they open source this, I think the apps and the amount of use cases that we're going to be getting for those things are really, really going to be really cool. Like, and then the wristband haptic, right? That they have, I think that's also just like a breakthrough in technology that I think, like myself included as a Meta bull, I didn't think it was going to be probably as good as it was as soon as it was. Like I was kind of taken by surprise with that too. Did you guys watch it or looking into that at all?
Yeah, I watched it. I was about to
I
ask
watched
you
some of
because
it.
the wristband part also stood out to me. Like it's nothing new. Like this was articulated in advance,
Hmm.
but I think that's like such a fabulous piece of tech that makes me imagine a future where everyone wears AR glasses. Like it makes the whole vision more feasible, if that makes any sense.
Yeah, to me, that's actually like the way I was thinking of it, and I think a few others have kind of said this as well. I was more blown away by that technology than the fact that they were able to add a display
Yeah,
in the lens. Now, of course, I don't really know I'm sure it's insanely difficult to do that, right? I'm not downplaying the technology of that, but to come out with that wristband or that, right, where you can just lightly move your hands and you can be texting or navigating
Yeah.
what is being displayed to me, that is really, really cool. That is very futuristic to me. And I can see that that's a first generation. It is hard to imagine that they don't partner with someone like Garmin to come out to develop that wristband into like an actual watch, right? Like a wearable. Because
yeah,
what people aren't going to want is to have a watch in one hand and then like that wristband in the other hand. I think they're going
that
to
makes
want
sense.
just
Yeah.
one thing on their wrist, right? So is going to have to be a watch. It's going to have things that did I break up with you at all there? My
Yeah,
Yeah,
glasses
you
closed.
did a
but just
little.
for a few seconds,
Just a
you're
few
good
seconds.
again.
Okay. Yeah, I just think that, that's going to be coming down the pipeline, but I just think that people are going to want that one wristband to kind of do what smartwatches do already, plus be able to control your glasses. But it was really, really cool to me. And I think they are probably years ahead of competition. I think it kind of took a lot of people by surprise.
Perfect. Perfect.
That's my guess.
So let me just suggest how we proceed because we are already at 1 hour and 11 minutes. I would
Cool.
suggest we are going to skip the other news. I might just quickly say what I had in mind we could discuss, and then we'll look
Okay.
at one more stock for snap judgment. Does that sound good to you?
Works for me.
Let's do it. Yep.
Perfect. So just real quickly, the other news pieces I had prepared were
Oh, can I make one more point though?
yeah,
I'm when it comes to these glasses and stuff, I think that maybe this won't be the final iteration of what we would call a wearable tech in the like for a text or phone kind of thing, because you still have Johnny Ive working with OpenAI making a
interesting.
product
Yeah,
that we don't know about. I do know a few people work in tech, and they genuinely think that we're going to move beyond wearing glasses because
interesting. So an
as a
entirely new form factor.
yeah, you know, when I was saying earlier that maybe this maybe in the next 5, 10 years, this thing about using a phone or anything will be just we'll be thinking that's so bizarre, that's so archaic because we'll have moved far beyond that. There's something else will come which will be more convenient than having to put glasses on. You know, like have something which is almost not present, so to speak. That's what a
Yeah.
few people talk about, that they think that the next iteration will be something that feels more natural, which isn't so like present, like glasses or something. So although those meta glasses are incredible.
Yeah. Okay. I'll move on now. Thanks, Rookie. So the other news piece was that OpenAI and in their ChatGPT app or application, they are going to launch an instant checkout in partnership with Etsy and Shopify. That's an interesting news piece, but we won't get to that. Here, someone shared that this individual saw ads directly integrated into the Gemini LLM experience. Also super interesting. And I guess the big news piece in the value investing world was Mark Leonard stepping down as
Yeah.
the CEO of Constellation Software. But I feel like this would deserve like a longer segment. So let's just not get into it at all. And I think we all three are no particular experts on Constellation anyway. Is that right? Like I have a broad understanding of it. You might too, but I don't know. We might share just overly simplistic takes. Anyway, so let's do one stock where we just look at the financials and sort of I call it the format buy one, leave one when we look at two stocks, or the other name I came up for where we just look at one stock where we say, well, is it interesting or not? Ticker takedown. So I have a couple of contenders here, and you just pick one that we go with. So Constellation Brands would be one, Valaris Limited, Chapters Group, Edian or Visa as sort of her quote unquote battle. And let's just stick with these. Do you want to go with one in particular? I'll leave that decision up to you.
Rookie can decide. I've done enough talking.
Could you just run by the list again? Is that
Sure.
just
So Constellation Brands, Valaris,
Valaris?
Chapters Group, which is a German serial acquirer, Edian, Visa, and I could throw Nike and Fever Tree in the ring as well.
Ooh. I'm a bit selfish because I am fascinated by what people think or the future is with Nike. But let's go with Edian. That's more interesting.
Edian? Okay, perfect. I'll just pull up some numbers and I'll give you sort of, I don't know, should I start with my snap judgment?
Yes, please.
Okay, I'm just going to pull up a few numbers and you can chime in if you want. So what I would start with is just a business description. I'll sort of start with a qualitative assessment here. Let me just read it to you. So Adian operates a payments platform in Europe, the Middle East, Africa, North America, blah, 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 blah. Its platform integrates payments stack, including gateway, risk management, processing, acquiring, and settlement services. The company offers a back-end infrastructure for authorizing. It accepts payment through online and in-person payments, cross-channel, and Adian for platforms. The company also provides optimization services, including Adian Uplift, Protect, Authenticate, and Optimize. And I'll leave it there. So what I would be looking for here would be two things. First of all, would I be able to understand what the company is doing in the first place?
Yeah.
I think I could give this a positive here. And the other one would be, could the company potentially possess some form of structural advantage? And I do have like a broad understanding of what Adian does. And I think it also totally checks off that box as well. So it would sort of pass my quick qualitative filters. And then we would actually move on to the numbers, the quantitative side. And we're just doing this to sort of filter which companies we then want to dig deeper into. I will just say something quite interesting. So as you guys might know, I'm chatting a lot with Theo Berkern, and I brought up PayPal to him too, I think. And what fascinates me about his approach is we all have different strengths and weaknesses, but he has like really, really hard filters. And he also said like payments, nothing for me, just too competitive, too hard to predict in the current state. So I get why you would not let Adian through that qualitative filter from that point of view. So it just comes down to your circle of competence, I guess.
Yeah.
So I'm going to pull up a few numbers. We could take a look at the headline numbers here, which is just the development. So I visualize this on Koifen here for those just listening. And I visualized the development of free cash flow, revenue, net income, and EBIT over time. And what we see here is sort of a nice and steady positive development of all the metrics. I know you're both on your mobile phone, so you really have to zoom in, I guess. So just snap judgment, this looks like a growing business that is becoming more profitable over time. So that looks good. If we take a closer look at the, do you want to comment?
No, I said that does look good.
Yeah. If we zoom in on the margin profile more specifically, just bring up a few more specific metrics here. So free cash flow numbers are always skewed for payment companies, so let's just leave them aside. But gross margins of 67%, EBIT margins of 46% over the last 12 months, and the mean EBIT margins over the last 5 years are actually 50%. So that's already insane. That's like really, really, really impressive.
Yeah.
What else do we have here? Net income margins of 45% over the last 12 months. And what's the mean here over the last 5 years? 43%. So just looking at the margin profile, you know that this company has something special going for it, especially because it was able to sustain these margins over the last 5 years. And I'm not sure when Adyen went public. If we take a look at the numbers over the last 10 years, even then, the margins have stayed at such elevated levels, which already tells you that there must be something qualitative too that protects that profitability.
Yeah. Renee, so is this, let me ask you a question. Is that, so the reason I'm asking, the way I would start the analysis, same thing. First, I'm a little bit more hometown biased. So when it's ex-US,
I was about to say,
I already have a tendency to write it off. However, let's just imagine it was US based or something like that. Yeah, I go through the same process, right? Would I even, first off, am I even interested? Have I even heard of this before? Do I think I could understand it? Sure. Now moving on to the qualitative side, right? Most companies, full disclosure, I think I can speak for Renee, probably for Ruki as well. Most businesses don't even pass that first filter. Like probably 9 out of 10 don't even pass that first filter. But assuming we do make it to the qualitative side or the quantitative side, I mean, you start looking at these numbers first. Like
I would say,
is this the process you start with? Like,
so what I would say is there are a couple of things I would like to check, and I don't check them in a specific order. So profitability would be one. That's the one we just looked at now. I would look at growth over time. I just did sort of a snap judgment on that, but I would also take a look at what the actual CAGRs are over the last 5 years and the last 10 years of top line and certain profit metrics. Debt would come up to share dilution, return on invested capital.
Yeah. The reason I was asking is because we started with the cash flow and income statement. It's just
you want to start with the balance sheet, right?
I always start with the balance sheet. Yeah.
Yeah, which makes sense. I get that. So
yeah, I won't even look at growth if the balance sheet isn't because I always like to going back to Charlie Munger, invert, always invert, right? How can I lose money? Well, first off, this goes back to Peter Lynch. He says if a company has no debt, they can't go bankrupt, right? And the only way for a business to go to zero other than fraud is to go bankrupt. So typically, and it's not that they can't have any debt, but I don't even like to have to calculate for, people say, oh, they're 4 times, free cash flow. So in 4 years, they can pay off all their debt. Well, okay, that means I need to add 4 to my, like, if it's a PE of 10, in reality, it's more like a PE of 14 because 4 of those years are going to be spent paying off the debt. So I personally always like to make sure that a company has more cash and short-term investments than they do long-term debt. And the long-term debt, I say real debt, right? I don't count lease obligations to that. And I also make sure that I'm taking out that deferred revenue from debt because obviously that's not real debt. I only look at real debt. And so right off the bat, what's their balance sheet? Short-term investments, cash plus short-term investments compared to long-term debt.
Yeah. And I pulled it up here. So yeah. And I pulled it up here. So what you can see here in the top left corner is already the comparison of enterprise value and market cap. So market cap is 43 billion euros and enterprise value is 30 billion, which already tells you that the company is apparently, if the research terminal is not just like miscategorizing certain items, but it tells you that the company is sitting on a net cash position that is quite material,
Yeah.
right? And looking at the more specific numbers I pulled up here, so we have total liabilities, free cash flow, which, as I said, we're going to ignore for now, EBIT, total debt, and cash and short-term investments. So the company apparently is sitting, and that's based on April numbers. So let me move it to October. So the company is sitting on around 12.5 billion in cash and short-term investments versus 9 billion in total liabilities. But what stands out to me too is that the total debt is actually only 250 million. And what I would want to do next, but that's just a snap exercise, exercise here, would be to actually take a look at the balance sheet and see what the actual liabilities are. If I would treat them as actual liabilities, you mentioned lease liabilities, for instance, or not. And I would imagine, I don't know ADN well enough, maybe you have something smart to say here. I would imagine that the majority of that liability figure here may not necessarily, or does not necessarily deserve to be treated as a quote unquote real liability, but I'm not sure about that. I'm not sure if any of you know a similar company and can quickly make a comparison here.
Well, yeah, I mean it depends if they have a banking side of their business or not too. So
Yeah.
And it depends if
Yeah.
they sweep that off their balance sheet. For example, like PayPal technically does, like their buy now, pay later. Not debt, but it is a liability you would want to account for. But they do sweep that off their balance sheet to KKR. So like you just want to dive a little bit deeper into the footnotes there and kind of understand what's going on.
Yeah, and my strong hunch would be that this is the case here because the discrepancy between total debt and total liabilities and total long-term debt is so massive that probably the majority of total liabilities maybe shouldn't be treated as, again, sounds wrong to say it, like real liabilities.
Yeah.
So it passes that filter as well, right?
Yeah. For
Yeah,
me, that's where I would start, and then I'd go over into the profitability and everything too. But yep. So
me too.
Yeah, I'm not sure if it really has 10 years of data. So let's look at the 5-year CAGRs of certain metrics. So we see that growth is slowing down over time, but still, I need to move this to October this year again. Still,
minimum 5 years as a public company too is typically what I'll run as a filter too.
Yeah, definitely,
Because,
or even longer
because
sometimes.
Yeah, but bare minimum for me is kind of always 5 years. Just because businesses change a lot once they go public. Sometimes the founder has a nice payout, management changes up. Also,
Yeah.
they now, instead of thinking long term, whether they like to admit it or not, now they might be aiming towards quarterly numbers. Also, when a company IPOs, typically they're raising capital, in a good environment, they're raising capital when it's beneficial to them, which,
Yeah.
it's tough to imagine that you're getting the better end of that deal. And in most cases, so typically I like to give it 5 years and see where they shake out.
Yeah. Without dropping any names here, I'm currently digging into a company that listed just last year. So apparently that's not a strong filter for me. Anyway,
Yeah.
getting back to the 5-year CAGRs, so really impressive, even though the 5-year CAGRs over time are coming down. But as of today, and I'm not sure, it stops here in January for some reason. But the operating profit 5-year CAGR is 25%, revenue CAGR 30%, net income CAGR 31%. So I would guess there's some operating leverage at play here already, which I would expect from like a major player in that space anyway. I think we could already skip certain other parts like return on invested capital and shares outstanding, I guess, is relevant because there's too much dilution. This one might not be that interesting. So it's actually quite material over the last 5 years, both basic and diluted shares outstanding are up 30%. So what I would be more interested then would be the CAGRs on a per share basis. That would require a little more work.
Yeah.
I would like to
Yeah.
calculate that. But again, you develop some intuition over time. And if the top line compounds at 30%, depending on the price you pay, of course, but this can make up for that level of dilution quite easily. But it all comes down to valuation then. So let me just pull up a few valuation multiples here. Yep.
I'm going to predict that this is richly valued.
I think let's check the price development. I think the price has actually come down more recently, but I might be
Oh,
mistaken.
really?
I was gonna
Huh.
say my hunch, and I know I was going to say my hunch is that it's probably priced along with most of the existing payment businesses.
Payment bus-
Probably not as cheap as a PayPal due to the growth rate, but I wouldn't be surprised if it was, sub 25, sub 20 price to earnings.
Yeah. So as you can see, so
I don't know.
from the peak in summer 2021, the company never recovered these highs. And I think I do remember I looked at this stock chart not too long ago of ADR, and I think over the last 5 years it's about flat. And as you can see, it's down 50% still. It was down 76%, 70
at one point.
like 77% at one point, but it's still down 50% from the summer 2021 high. And on a multiple basis, we're looking at, maybe we use the EBIT multiple because the EBIT margin was quite stable over time. But still, like as you expected, Andrew, like a low 20s EBIT multiple, EV to EBIT
Yeah.
of 23 and 35 times next 12-month earnings.
Yeah, they're probably fairly valued based on their growth rates, honestly.
Yeah. So I don't know. I'm pretty sure this is a fantastic business, and I would be happy to look into it further at the right moment in time. I'm not sure if that would be the case at these multiples. But then again, I realize if the company can continue to compound at 20% for the next 5 years, these multiples look really cheap really quickly. So
Yeah, but there's EV to EBIT 23. I'd need to look deeper because why is
yeah,
their free cash flow 11 times? Do they have a one-off that increased free cash flow, or do they have one-off with margins that's suppressing net income? That's what I'd need to look into because there's, for example, a company I own that you know very well that looks like it's trading at 20 times earnings when in actuality it's probably normalized out to about 10 times earnings. But there's other businesses that I've seen that are genuinely trading at 25 times earnings, but if you look at free cash flow, it's like 10 times free cash flow. So that's one thing I'd need to see the
My experience
discrepancy.
is that for almost all financials companies, the free cash flow figure that pops up in research terminals is just skewed. And unless the company itself discloses the quote unquote actual free cash flow produced by the business, you're probably doing best just ignoring it. Because keep in mind, the EBIT multiple of 23 times is already based on, what was it, like a 41% margin or even higher. So
Yeah, that's true.
the free cash flow multiple is most certainly off.
Mm-hmm.
Interesting business. I don't know, like the fact that it's still down 50% and the stock is flat over 5 years, if I'm not mistaken. Please double check that. What's the format called? Ticker takedown. So if it would be like a gun to my head decision, I would look into this further.
Yeah, it didn't even pass my first filter anyway, so I was out.
The US filter.
Yeah.
Okay.
Yeah, I think
So
I would look into it further, but I would.
looking at the time, as always, we miserably failed, which is fine, but we had a good time. That's what this is all about anyway. We had 1 hour, the 1 hour 32-minute mark. I just want to thank the two of you again for taking the time to join us here. Let's hope some people learn something from our discussion. Keep in mind, no investment advice. We're just doing this for fun. And you always have to consider your personal financial decision and should talk to your financial advisor before making any financial decisions and investment decisions. Anything you want to add here, or should we call it a day?
Nope, nothing
Okay.
to add.
Thanks very much,
Nothing to add
and
from me.
we'll talk. I'm sure we'll do this in this format too at some point in time. So let's talk soon. Take care. Bye.
Talk soon.